Happy New Year, my good man.
Happy New Year.
Hope the holidays were good to you.
Very good.
What's going on in the world here, other than the weather? I noticed you had a really thick jacket out there.
I do. Hong Kong seems really cold these days.
It does, doesn't it? I mean, 10 degrees is like is Arctic weather for us here. Is this one of those knee-jerk things going on out there? Oil and energy, gas seems to be kind of in play right now. Is that just a direct sort of weather thing? When it warms up over the weekend next week, are we going to forget about this?
Not necessarily. Obviously, there's an impact from the weather because it's a headline news that temperatures are falling a lot. But I think in the first quarter of this year, risk appetite is going to be strong, and therefore demand will be high for risky assets, including commodities. So I'm not surprised, even if temperature goes up, that their prices will continue to move north.
Why would risk appetite be on the up this year? I mean, 2009 was a crazy beta year. Up until March, people were pulling back like there's no tomorrow, and they said, what the hell, everything has been debased so far, and the baseline has been brought so far south, it doesn't really hurt you to take a little punt here, whether it's in the hedge market, in the ARBs, or in the derivatives market, or whatnot. Why would people want to continue, considering the kind of capital gains that many enjoyed, in 2009?
Well, the gains were really very strong. However, they still left a lot of asset prices well below levels that we saw before the crisis. So investors can think that there is still room to catch up. But more importantly, global growth is only beginning to accelerate. Q4 was the first one when year-on-year growth for the whole global economy was positive after the crisis. And it will zoom to over 5% year-on-year in the second quarter. So right now we are flooded by all the positive news on the macroeconomic front, and this is making people more optimistic. You
sound more optimistic than you did at any point last year.
Well, obviously last year was a really bad year. I am optimistic for the global economy this year. It will expand by 4.4%. However, for the markets, I'm upbeat only through the spring of this year. After that, investors will begin to be concerned about the double dip scenario, which is something what I believe in. And because
how much of this is real growth, though? I mean, if the governments didn't step in, we wouldn't even be talking about this right now, would we?
Obviously, we wouldn't. So the price tag is the huge fiscal deficits, and they will have to be paid for in the years to come with higher tax rates, lower government spending, and so forth. But markets are not looking so far ahead. They're focused on the next 2-3 quarters. So far, so good.
What could the hitch be? What could the trigger be? What could the swing factor be? I mean, if there's one major thing that they might screw up on in terms of policy, like maybe withdrawing stimulus too early or something like that, do you think that might be the big litmus test that might send us where we hope we won't go back to?
It would definitely be, but actually the way that policy is set right now, it's set to expire on the fiscal front by the end of this year. China, US, their fiscal stimulus packages were only for 2 years, so towards the end of 2010 they will be running out their course, and private sector demand will not be strong enough to pick up the baton. Markets forecasting such a scenario will begin to take a major correction sometime in the spring.
Okay, big question on policymakers' minds around the world still to come. Is it going to be more and more stimulus, or is it time to suck it all back? There's a certain element of schizophrenia out there, a tightrope of delicate, fine act balancing central banks' debate over the need to stimulate versus when it absolutely positively has to end. We'll take that up next. Yeah, bunds, right?
Yes, for the 10-year sector, it's bunds.
Is that where you want to be? I don't think I've ever talked to you about that.
No, we never did, but it's a very good topic. I think that not only German bonds, but G3 government debt is going to trade range-bound this year with downside bias in terms of yields, because I believe that the double dip scenario that Gross was talking about is very real, and that monetary policymakers will stay put until well into 2011 to stave off the risk of another slump. But I don't think the German bonds are the best place to be. I would be buying treasuries because their yields have risen much more than those of bonds in Q4 last year, and now they have to come down.
Where? Short, middle, or long?
Oh, I'm buying the 10-year sector.
Okay, so you're buying the mid, right?
Yes, because the short end is very anchored by Fed funds.
Very affected by the little bits and pieces that dribble out of policymakers, right?
Exactly. So it will be fluctuating around 1%.
Okay, but you're talking about a recession scenario. The only reason you'd want to bunk all your money into bonds is because you don't think that things are going to get out of the woods. They're just going to be stuck in the forest for a long time to come. Is that what you're seeing among the G3?
Oh, definitely. My scenario for this year is that first quarter is going to be really good. Risky assets will be going up. Treasury is probably staying around current levels, but from the spring going into the second half of the year, all risky assets will go down and treasury bond prices will go higher. And sometime at the end of Q1, I will be massively investing in treasuries.
Then why 10-year? Why not buy the cheapest, longest dated strips that you possibly can? Isn't that where you can really get a multiplier effect on your money, given that kind of scenario that you're painting here?
You might be doing this as well. However, I think that the market will be more concerned in terms of the fiscal outlook in the longer run when it comes to the 30-year, to the longer end. So I think that there is much more volatility risk there than at the 10-year segment.
You know what I find, what kind of flummoxes me a little bit is you talk about double dip, and you've already used the term 4 or 5 times, and we're still early in the show today, and yet you see nothing but sunshine ahead for equities. I guess that's about it in the U.S. context, right?
Yeah, in the U.S. context and globally, equity markets will be going up through the spring, because this is the time when the global economy will be the hottest.
Spring is only 2 months away.
Well, through the spring, meaning probably to the middle of the spring, something like that. Sometime in the middle of Q2.
Oh, through the spring, not to the spring, okay.
Yeah, sometime in the middle of Q2, we are going to see S&P 500 around 1250, 10% up from current levels, and emerging market indices, especially China, about 20% higher. However, by that point, equities which forecast macroeconomic cycles with about 2 quarters ahead will begin to price in the double dip. Then we'll get a slump, and the end of this year will be lower than current levels.
So in other words, we can enjoy the ride for a little more, but watch it, because there's going to be a point where the roller coaster is going to get to the peak, and then it's just downhill from there on. Okay, so it's all in the timing. See, that's the trick here. That's the issue, is you've got all these asset classes on different cycles. Okay, we continue with Darius and Olivia, still to come. Japan taking quick action. The 6th finance minister in a year and a half. Darius, this new finance minister is a spending advocate. He's one for prime the pump. In a country where the what's the term? The budget deficit to GDP, accumulated deficit, is 200%, right? Or very close to that.
Yes.
Is that a great idea? Because this is a country where you have fewer and fewer people paying taxes as the days and the months go by.
Exactly. But I think he is the right man for the job. Because yes, because what Japan needs desperately is to actually implement the electoral pledges of Prime Minister Hatoyama, who wants to focus on boosting the demographic growth rate. This is absolutely critical, because Japan is becoming an imploding black hole.
A zombie nation.
Well, I wouldn't go that far, but basically, the population is beginning to shrink, and then if you do not reverse the process, and you can only do it by boosting the growth rate, by subsidizing children, right? This is the only way, and they have to spend on that, because if they don't do it, nobody will be left there to buy their high-tech products or even to manufacture them.
Haven't they tried that though before? Baby making bonuses? It really doesn't work, right? I mean, it's great to get a few thousand or a few tens of thousands of yen, but then when you add up the cost of 18 years of child rearing, it's still a money-losing proposition. Well,
I think the government has to focus on subsidizing the families to actually have children to a larger degree than they did in the past. It's much more important than building a new highway or new airport, because who will use the highway? Why would you want to build more highways when you have a shrinking population? That's what I'm saying. Actually, Hong Kong does stupid things like that too, don't they? I mean, build expressways when the population is stagnant here. Well, yeah, but it may increase when we have the inflow of population from mainland China, right? But in case of Japan, they don't really want to import foreign workers. Right? Well, they need to. They don't have enough nurses in that country. See, that's the problem, because other countries, even Germany, right? They opened their labor market to foreigners, and this is what's keeping them alive. But Japan has not, at least to the same degree. So either they have to do that, but culturally I doubt it, or they really have to spend more on stimulating positive demographic trends. So Khan is a good one here, because he is more aggressive in fiscal spending. This is kind of the old argument about remember when we were in the midst of the lost decade and everybody was scratching around for some idea of what to do. There was talk about inducing inflation. I think Krugman at that point was saying, print a lot of money so people are scared to keep it stuffed under your tatami mat or whatever. This is sort of the same argument, isn't it? You've got to get the velocity of money going in a country of this, in this kind of straits. Well, I don't know if Khan will go that direction. I really think that they should invest in all stages of supporting a positive demographic trend. But in any case, it's better right now, when there is a risk of double dip in Japan as well, to have somebody there who is more fiscally aggressive. Their deficit is 200%. At some point, it will become a problem, right? But it hasn't become a problem at 150. It doesn't seem to be a problem now. Why not spend a little bit more to try to get to a new level, on a new trajectory for the whole economy? Right. And he's also very good for advocating a weaker yen. This is necessary. A stronger yen would kill Japan.
Mike, is the yen ever going to go back to 100, 120?
I think that it will move towards 95 by the spring this year, but if the global economy does slow later on, then the risk aversion will bring it further south towards 90. So 120, I doubt it.
You see opportunity though in the wider market, the topics. You see a possible 15% advance and maybe a little bit of coming back, but still net holding on to gains. So there is value to be unlocked in this market.
Well, definitely. I mean, all asset classes globally are still highly correlated. So if equities are going to move higher for the first few months of the year elsewhere, they will move up in Japan as well, especially if the yen continues to weaken, which I think is likely, because this will boost the valuation of exporters.
It's the one market, unlike the rest of the Asia Pac, which hasn't scooted up to highs. I mean, we're at 1/4 of the all-time high during the big build-out in the 1980s, right?
Not only that, but it's also the market in Asia.
It's a cheap market?
It's not cheap, because when you look at price-earning ratios, it is the most important, right? It's the most expensive in Asia. But it's still the one market in Asia that recovered the least of the recent crisis collapse. China is the second one, actually, interestingly. It recovered only a third.
Right. Okay. We're going to talk this through. Correlation in asset classes, an ongoing theme here in the show. Still to come, the tech chartists say bunk to the idea things have overshot. Mr. Fibonacci says things may flourish. We'll tell you why.